The shadow credit freeze of 2026, when Canada's banks quietly turned off the tap. There is a sound echoing through the hallways of the frantic Canadian real estate market right now. But it is not the sound of construction, and it is certainly not the sound of sales. It is the sound of silence. It is the sound of a door slamming shut and a deadbolt sliding into place. For the last 2 months, while the mainstream media has been distracting you with stories about minor interest rate cuts and the supposed resilience of the Canadian consumer, the big six banks have quietly, systematically, and ruthlessly initiated a shadow freeze on lending. This is not a conspiracy theory. This is not speculations. This is happening in branch offices from Halifax to Victoria. The tap has been turned off. The liquidity that fueled the Canadian housing bubble for 20 years has evaporated. They haven't announced it in a press release. They haven't told the CBC. But try to get a mortgage today. Try to get a line of credit increased. Try to refinance a property that you bought in 2021. You will find that the bank, your partner, the institution that smiled and handed you money when you didn't need it, has suddenly become a fortress. They know what is coming. They have seen the internal data. They know that the insolvency wave is about to crest, and they are doing the only thing a bank does when it smells blood in the water. They are hoarding cash and leaving you to drown. Welcome to the credit freeze of 2026. This is the catalyst that takes us from a correction to a depression. Today, we are going to expose the internal panic happening inside Canada's financial institutions. We are going to break down the leaked signals that prove they are preparing for a 30% default rate. And we are going to explain why your perfect credit score no longer matters. The evidence, actions never lie. Let's begin with the evidence, because the banks are masters at gaslighting. If you listen to the public statements from the CEOs of RBC, TD, or CIBC, everything is manageable. They talk about normalization. They talk about prudent risk management. But look at their actions. Actions never lie. In the fourth quarter of 2025, Canadian banks increased their provisions for credit losses, or PCLs, by billions of dollars. This is money they are taking out of their profits and locking away in a vault because they expect loans to go bad. You do not set aside billions of dollars if you believe in a soft landing. You do not hoard capital if you believe the economy is recovering. You do this when you are preparing for war. But the PCLs are just the tip of the iceberg. The real story is the change in adjudication criteria. We have spoken to mortgage brokers, underwriters, and bank managers who have spoken to us on the condition of anonymity because they are terrified of losing their jobs. They all say the same thing. The black box has changed. In the past, if you had a credit score over 700 in a job, you got the money. Today, the algorithms have been tweaked to reject applications that would have been approved just 6 months ago. Why? Because the banks are no longer valuing the collateral, your home, at the price you think it's worth. The appraisal massacre. This is the secret that destroys the market. When you apply for a mortgage, the bank sends an appraiser. But in 2026, the banks have instructed appraisers to be conservative. That is code for slash the value. We are seeing appraisals coming in 10, 15, sometimes 20% lower than the purchase price. The bank then uses this low number to deny the loan or cut the loan amount, forcing the buyer to come up with hundreds of thousands in cash. When the buyer can't, the deal collapses. The bank says, "We didn't deny you, the numbers just didn't work." It is a passive-aggressive way of freezing the market without officially declaring a freeze. They are choking the life out of the housing sector while pretending to be open for business. Why are they doing this? Because they are terrified. They are looking at the same charts we are. They see the renewal wall. $2.2 trillion of mortgages are renewing between now and the end of 2026. They know that the average Canadian household cannot absorb a payment increase of 30 to 50%. They know that unemployment is trending up, not down. They know that the consumer is tapped out. If they lend you money today, they calculate a high probability that you will default within 18 months. So, the strategy is simple. Stop lending. Shrink the balance sheet. Let the small lenders and the private mortgage investment corporations take the risk. Let them go bust. The big six are entering survival mode. The human cost. Real stories. Let's look at the reality on the ground. Let's talk about the people who are being crushed by this invisible wall. Consider the case of a small business owner in Vaughan, Ontario. Let's call him Mark. Mark runs a successful contracting business. He has never missed a payment. He owns 3 properties. In any normal economy, Mark is a AAA client. Last month, Mark went to his bank to renew his operating line of credit, money he uses to buy materials and pay his guys before the clients pay him. The bank cut his line by 50%. No explanation, no negotiation. Just a letter stating risk exposure adjustment. Mark is now scrambling to find payroll. He might have to lay off 5 guys next week. This is how a credit freeze creates a recession. It's not just about houses, it's about the gears of the economy grinding to a halt because the oil, credit, has been removed. Or take the story of the refinance trap. We have thousands of viewers who bought homes in 2021 using private lending or B lenders, planning to switch to a major bank when their credit improved or the term ended. The term is up. They went to the big banks this January. They have the income, they have the credit score, but the big banks said no. Why? Because the bank looked at the property and said, we don't want exposure to this condo building. We don't want exposure to this neighborhood. The banks are redlining entire zip codes that they deem high risk for price collapse. These borrowers are now trapped. They have to go back to the private lenders, who are now charging 12, 13, 14% interest. This is a death spiral. The bank's refusal to lend guarantees the borrower will eventually default. The regulatory stranglehold. And who is the culprit? Who allowed this to happen? We have to look directly at the Office of the Superintendent of Financial Institutions, OSFI, and the Bank of Canada. Peter Routledge at OSFI has been quietly tightening the screws on the banks behind the scenes. While the politicians talk about housing affordability, the regulators are forcing banks to hold more capital against their mortgage portfolios. They are effectively telling the banks, if you lend on a mortgage where the loan-to-value is high, we will punish you. They are inducing this credit crunch to protect the banking system at the expense of the Canadian citizen. They are sacrificing you to save the banks. And let's not forget Tiff Macklem, the governor of the Bank of Canada, creates the illusion of help by cutting the overnight rate by 25 basis points here and there. It is a show. It is theater. The overnight rate doesn't matter if the banks won't lend. You can lower the rate to 0, but if the bank manager says application denied, the effective interest rate for you is infinity. Macklem knows that the transmission mechanism of monetary policy is broken. He pushes the gas pedal, but the engine is disconnected from the wheels. The banks are the transmission, and they have decided to park the car. The commercial real estate contagion. But there is a darker layer to this. The banks are not just worried about you. They are worried about themselves. They are worried about the contagion from the commercial real estate sector. Look at downtown Toronto. Look at downtown Montreal. Office towers are empty. Commercial valuations have collapsed. The banks are sitting on billions of dollars of bad commercial loans that they haven't fully written down yet. They are using the profits from the residential side to cover the losses on the commercial side. But now that the residential side is cracking, they have nowhere to hide. They are freezing residential lending to preserve liquidity for the inevitable bailout of their commercial mistakes. You are being denied a home loan so that the bank can survive its bad bets on office towers. This brings us to the most terrifying realization of all. The banks are betting against Canada. When a bank stops lending to its own population, it is a vote of no confidence in the country's future. They are essentially shorting the Canadian economy. They are saying, we do not believe that the average Canadian will be richer tomorrow than they are today. They see the declining productivity. They see the exodus of young talent. They see the capital gains tax driving away investment. They look at the policies of Justin Trudeau and Chrystia Freeland, and they see an economy that is structurally broken. A bank is a profit-seeking machine. If they thought Canada was booming, they would be throwing money at you. The fact that they are closing the vault tells you everything you need to know about the real state of our nation. Beyond mortgages, total credit contraction. Let's go deeper into the mechanics of this freeze. It's not just mortgages, it's auto loans, it's credit cards. Have you noticed your credit card limit offers disappearing? Have you noticed how hard it is to get a car loan approved compared to 2 years ago? The delinquency rates on auto loans and credit cards are the canary in the coal mine. They are skyrocketing. The banks know that before people stop paying their mortgage, they stop paying their visa. They stop paying their car note. The data on credit card arrears is flashing red. This tells the bank's risk algorithms that the consumer is drowning. So the algorithm reacts globally. It tightens everything. It creates a self-fulfilling prophecy. By cutting credit limits, they push people into insolvency faster, which justifies more tightening. What history tells us. What happens next? What does history tell us? If you look at the credit crunch in the US in 2008 or the Japanese crisis in the 90s, the pattern is clear. The credit freeze precedes the asset price collapse. You cannot sustain asset prices, whether it's houses, stocks, or used cars, without credit. When the credit goes away, the only buyers left are cash buyers. And cash buyers do not pay market value. They pay liquidation value. They are vultures. We are about to see the vulture phase of the Canadian housing market. This spring, you are going to see a flood of listings. The media will cheer. Look at the inventory. Buyers are coming back. But watch the sales numbers. Watch the days on market. The listings will pile up. The buyers will go to the bank, get rejected, and walk away. The sellers, desperate to sell because they can't afford the renewal, will lower their prices. Then they will lower them again and again. But without credit, the buyers simply cannot transact. The market will seize up. A seized engine doesn't just stop, it explodes. We are looking at a scenario where house prices could drop another 20 to 30%, not because people don't want to buy, but because they can't buy. The banks have removed the ladder. What you must do now. So, what is the conclusion? What do you do when the institutions designed to serve you turn against you? First, you must understand that cash is king. If you have access to liquidity, preserve it. Do not pay down low-interest fixed debt if it leaves you with zero cash reserves. In a credit freeze, the person with cash makes the rules. If the bank cuts your line of credit tomorrow, you need to be able to survive without it. Second, do not rely on a pre-approval. A pre-approval in 2026 is worth less than the paper it is printed on. It is subject to appraisal, subject to final review, subject to the bank's mood on closing day. Do not make firm offers without a financing condition that is bulletproof. We are seeing people lose their deposits every single day because they thought a pre-approval was a guarantee. It is not. Third, if you are a business owner, look for alternative financing now, before you need it. The big six are closing ranks. You need to build relationships with credit unions, private lenders, or look at scaling back operations to be cash flow positive without debt. The era of cheap, easy operating capital is over. And finally, you need to stop listening to the official narrative. The government tells you the economy is strong to keep you spending. The banks tell you they are here to help while they foreclose on your neighbor. The system is protecting itself. You need to protect yourself. The freeze is here. It is secret, it is silent, and it is deadly. The banks have made their move. They have bet on a crash, and the house always wins. If the banks are betting on a collapse, why are you still betting on a boom? We will keep digging. We will keep finding the internal memos and the whistleblower reports. But we need you to stay awake. This channel is your lifeline to the truth in a sea of financial propaganda. Subscribe, share this video with anyone looking to buy or refinance, and tell them to watch out. The vault is locked. Winter is here.